It is tax day. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, automakers get some relief, but more tariffs could be coming soon. President Trump starts probes on pharma and chips.
China grounds Boeing. Beijing orders its airlines to stop taking deliveries from the U.S. plane maker, escalating the trade war.
And Bank of America and Citi wrap up big bank earnings with record results, while J&J kicks off earnings from Big Pharma. So let's get into that right now. J&J maintained its earnings outlook despite the potential for tariffs on the pharmaceutical industry, but that is what is weighing on the stock right now, Matt, down 1.5%.
All right, and we're also looking at Boeing shares right now down 3% after China ordered companies to halt Boeing jet deliveries as well as purchases of parts from U.S. companies for any of its aircraft.
Watching the banks here, Matt, because of course they did maintain their guidance as well. Bank of America and Citigroup, the latest banks to report a spike in trading revenue amid global tariff volatility. Bank of America CEO says investors are facing a fast-changing economic future, Katie.
And a lot of that future depends on just how the U.S. trade war plays out. Yesterday, Treasury Secretary Scott Bessent told Bloomberg Television that current tariff levels are at the high end in order to spur negotiations.
Well, look, the Treasury has lots of things we can do, and but again, I think we're a long way from that. But again, we have a big toolkit that we can roll out. We do regular off-the-run buybacks. We could up the buybacks if we wanted.
All right, Scott Bessent there talking about the tools that are at his disposal if yields rise too far, too fast. The Trump administration also has initiated trade probes into semiconductor and pharmaceutical imports, which could lead to more tariffs. Bloomberg's Tyler Kendall is at the White House with the details. Tyler?
Yeah, hey, Matt. So the administration has formally announced those Section 232 investigations into semiconductors and pharmaceuticals, largely seen as the precursor for the administration to impose tariffs on the basis of national security concerns. Now, we've learned that the administration actually started these probes back on April 1st. That means that the Commerce Secretary, Howard Lutnick, now has 270 days from then, roughly 9 months, to complete his findings that would then spur the tariffs. However, we know that this White House would like to see this done under more of an expedited timeline. Lutnick himself has said that we could expect to see them imposed in the next 1 or 2 months. Now, I actually had the chance to speak with one legal expert who told me that the fact that this White House is looking to impose these sector-specific tariffs under Section 232 very likely means that they're looking for a more durable legal basis here, which could result in these tariffs being on for longer compared to some of the other emergency powers that we've seen invoked, perhaps for the so-called reciprocal tariff plan as one example. We should also say that these investigations are pretty broad-ranging. They include pharmaceuticals, but also the ingredients that go into pharmaceuticals. They include chips, but also the equipment used to make chips, and then those downstream products like consumer electronics that have chips in them. Matt, I'll also just quickly add that this White House has opened the door to potentially some negotiations with the private sector. President Trump said over the weekend he would be open to some product-specific exemptions when it comes to tech imports, and as you well know, said yesterday that he could potentially be issuing at least a temporary reprieve for those automakers who move part production to the U.S.
All right, so a fluid situation, to say the least. Bloomberg's Tyler Kendall joining us from the White House. We'll get into all of those sector-specific tariffs in just a few moments. But let's talk about Boeing, because Boeing is the latest target in the U.S.-China trade war. Beijing has ordered its airlines to stop taking deliveries of Boeing jets and to also halt purchases of aircraft-related equipment and parts from U.S. companies. Bloomberg's Sid Phillip covers aviation. He joins us now to explain. So, Sid, I'm wondering if this is more symbolic than anything else, because this comes after China unveiled retaliatory tariffs of 125%. So it already would have been too expensive to keep up with these purchases.
It would have, because, I mean, obviously, when you're buying a $100 billion plane, 125% on top of that would make it sort of impossible for the airlines. And also, it would sort of make it impossible for the airlines to continue buying parts from America, especially since the tariffs are also on those parts. And so it is symbolic, but it's also sort of a massive blow to Boeing, because obviously China is a huge market for Boeing. Boeing expects it to be about 20% of its market going forward. And it was about a quarter until 2018 when Boeing was stopped selling the MAX because of the crashes.
Does that mean that they won't be buying any planes going forward, though, until negotiations happen?
It does look like that. It does look like the Chinese government has told the airlines to stop taking deliveries of Boeing aircraft until such time as they can sort of reach a deal. I mean, that's the underlying message, that essentially until there is some sort of agreement between the US and China, Boeing planes are off the menu for the airlines in China.
Sid, we thank you for your reporting. That is Sid Phillip of Bloomberg News. We're going to turn now to bank earnings, because Bank of America posted record trading revenue in the first quarter. Citigroup's revenue helps it get closer to Jane Fraser's profitability target. RBC Markets head of U.S. Bank Equity Strategy, Gerard Cassidy, joins us now. Positive reaction, fairly positive guidance here across the board, really. Still a lot of caution, a lot of investors still worried about capital markets, a deal freeze, CEO sentiment. Where is your head at right now after we have all the information, Gerard?
Sure. Thank you for having me on. And what we saw across the board from all of the big banks is that trading results led by equity trading were at record levels for many of them. The investment banking activity, as you pointed out, was generally lower than expected because of the uncertainties in the market. So as we move forward, as trading results remain, volatile, or I should say trading markets remain volatile, the trading results should probably continue to be robust in the second quarter, but the investment banking activity is likely to remain on pause. In fact, the JP Morgan even indicated that they're lowering their expectations for some of the ECM business or the IPO business as we go forward. The other important trend, though, in this quarter is credit quality for the industry remained very strong, and the capital levels and liquidity are very healthy. So the industry is prepared for any slowdown that may come as a result of the Trump administration's tariff policies.
And Gerard, I just want to step back, and now that we have, all the big ones out of the way, just what this says about where we are. These banks are looked to, and these executive comments are looked to as sort of a bellwether when it comes to the U.S. economy, when it comes to basically the health of the U.S. consumer. It was only JP Morgan, I think, that set aside more than expected for loan loss provisions. You really didn't see that from its peers. And I wonder, when you boil it all down, what are you left with?
Many of the banks looked at the reserving of their for their portfolios. As you might recall, the industry had to shift the reserving methodology in January 2020 to factor in the outlook for the economy and the impact it may have on the loan portfolio, known as CECL accounting, current expected credit loss accounting. And so everybody did that in the quarter. It turned out that JP Morgan's build was about $1 billion, but other banks looked at it as well, and they built up reserves, but they also had some reserve releases in other parts of the portfolio. So the net increase maybe was not as large. But all of the banks are building the reserves in anticipation of higher unemployment based upon their analysis.
It's interesting you end with unemployment, because I was going to ask about banker jobs. How does it look for, Bloomberg clients watching BTV right now? Are there jobs guaranteed for the year? Is this going to be a good year for bonuses, or is the uncertainty in the economy also leading to uncertainty for them?
It's interesting because the traders are certainly, if this activity continues throughout the year, that part of the business should see strong bonuses, and, employment will remain very healthy. But on the investment banking side, you have to question if this first quarter is carried out through the entire year, then certainly revenues will be disappointing and bonuses won't come in as strong as maybe some people had hoped. And maybe there will be some headcount reduction as well. Too early to make that call, but certainly that's something that should be looked at as we get through the second quarter and we enter into the summer months.
One question I have, Gerard, is do these bank earnings that we've seen so far really give a bigger picture of the economy? You looked at Bank of America. They did something I don't remember them doing for a long time. They gave you their FICO scores relative to where they stood in the end of 2009. And currently with an average FICO of 777 for a credit card at Bank of America, it's hard to believe that their credit quality says something about the rest of the financials and the larger consumer picture that really exists in America.
It's interesting. Bank of America, as we all recall, came close to failing back in 08, 09, and under the leadership of Brian Moynihan, he's turned the bank around and has built up a very strong balance sheet, very similar to the other large banks like a JP Morgan. And that slides that they're distributing, and they have done this before, they really want to show investors how they've changed since those dark days in 2009, and he has de-risked the balance sheet. And that shows up, as you pointed out, in these FICO scores for the consumer, but also in the corporate and commercial lending area as well. But this is true for the industry. You know, the banking industry is not generally a subprime lending industry. That's obviously the non-banks. But the banks on the consumer side have prime credits and super prime credits. However, in a rising unemployment market, you know, the rate of unemployment by the end of this year reaches 6%. Rest assured, the consumer credit losses will go up in that kind of environment.
Yeah, a 6% unemployment rate would truly be stunning. Let's hope it doesn't come to that. RBC's Gerard, Cassidy, great to spend some time with you. Let's take a check on these broader markets right now. You can see the S&P 500 just about unchanged. The NASDAQ 100 not too far off those levels, while small caps fall a little bit. The S&P 500 coming off 2 straight days of gains. We're looking for a catalyst right now, and maybe it'll come from the White House, because coming up, the Trump administration moves to put tariffs on chips into motion. We'll take a look at the potential impact next. This is Open Interest.
Let's get now to high interest. Look at what's making headlines around the world. Treasury Secretary Scott Bessent has has watched the recent bond market sell-off, and he's got ways to deal with it. In an exclusive interview with Bloomberg's Anne-Marie Horton, he said the search for Fed Chair Jay Powell's successor will be underway soon.
Well, we think about it all the time. I think when are we going to start the interviewing candidates? And that'll be sometime in the fall.
Powell's term runs out in May of 2026. President Trump chose him to lead the central bank back in 2018. Caterpillar has a new CEO, Joe Creed, a nearly 30-year veteran of the ag machinery giant, will take the reins from the current CEO, Jim Umpleby, effective May 1st. Creed, who is currently the company's COO, is stepping up at a time of heightened uncertainty for CAT. The company warned in January that full-year revenue will be lower thanks to declining sales. And the Trump administration is freezing over $2 billion in federal funding for Harvard University. It happened hours after the elite college rejected a list of demands from the government that were said to be designed to fight anti-Semitism on campus. But the president of Harvard says the request crossed red lines regarding academic freedom and interference in higher education. Sonali?
And we're going to turn now to chips, because the Trump administration is starting a probe into semiconductor imports. The move is seen as a precursor to tariffs on critical goods like microprocessors. Joining us now, Mandeep Singh of Bloomberg Intelligence. This is so much more targeted than we've seen with the blanket tariffs so far, and they're going for the heart of the infrastructure. It seems like a lot of companies will be treated very differently. I'm sure we're going to ask a lot about NVIDIA, but I actually am equally curious about what it means for the likes of a TSMC.
Yeah, look, I think what they're going after is critical infrastructure, and really, semiconductors is of national security importance. And that's why this is, from going from reciprocal tariffs to sector tariffs. And when you think about semiconductors is almost 12 to 15% of global trade. So this is like as big as anything it can get in terms of global trade. And you want to study the supply chains, because like if you're importing laptops, it's very different because it's an end product, whereas semiconductors is what China is importing in turn. So like the supply chain aspect is critical because China is exporting rare earth, they're importing chips, and once you know exactly where the key kind of pain points are, and TSMC is definitely one of them because they are the ones who are the manufacturing hub for advanced nodes. That's when you work on those companies, which is what they did with NVIDIA and TSMC announcing yesterday that they are setting up this facility for AI supercomputers. And then you expedite the permits for those type of companies. And I think that's the approach they're going to take going forward compared to the blanket tariffs, the reciprocal tariffs that came.
So you mentioned NVIDIA, but talk a little bit more specifically about NVIDIA. It's still one of the biggest companies out there, and it really sets the tone for sentiment when it comes to the AI trade and, in some respects, the broader tech trade. So where does this leave NVIDIA potentially, this probe?
Yeah, so I'm thinking, the supply chain for NVIDIA servers is very different from a supply chain for Apple smartphones, for example. And, a smartphone has thousands of components, whereas a server has, to an extent, fewer components than what goes inside a smartphone. So when you think about giving companies incentives to relocate their complete supply chain, it has to come from NVIDIA as the company or Apple as the company that really creates the product, using a global supply chain. And I think that seems to be a much more practical approach in terms of bringing manufacturing back, because that's the end goal, reshoring of all these products here in the U.S.
In terms of national security, the New York Times had a great story during the Biden administration about how NVIDIA kind of got around the rules and actually was selling these really high-tech chips to China, which then turns around and uses them for its military purposes, among others. Is the Trump administration going to be able to really clamp down on NVIDIA so that they don't find, ways through Singapore to get chips to Beijing?
Absolutely. I think that is part of this probe that is set up, is not just to look at the imports when it comes to the supply chain, but also the exports of restricted chips, the semi-cap equipment, the ASML machines that you need to, set up your fabs. So clearly there is that aspect in terms of figuring out how they were able to get around the export restrictions and what that means in terms of their ability to, create chips for training LLMs, like DeepSeek controversy, where how many NVIDIA chips did they have access to. So all these things, I think, are part of this probe, and that is what will determine how they kind of work around reshoring some of the manufacturing for these products.
And the story is just beginning. Mandeep Singh of Bloomberg Intelligence, we appreciate all of your analysis. And we are less than 12 minutes to the opening bell. We're going to begin the trading day with Sinead, Colton, Grant of BNY Wealth. Stick with us. This is Bloomberg Open Interest.
Well, Bank of America's latest monthly survey highlighted some serious angst for investors. 82% of fund managers expect the global economy to weaken, and a record number intend to reduce their exposure to U.S. equities. That is the most negative investor sentiment read in 3 decades. Joining us at the desk to break it down is BNY Wealth Chief Investment Officer Sinead Colton Grant. Sinead, great to see you with us.
Thanks, Katie.
So let's talk about this survey. Of course, it turned a lot of eyeballs this morning. Folks worried about just how bad it feels out there. From where you're sitting, from the conversations that you're having with your clients, are you hearing some of the same remarks?
Well, I think, first of all, just in terms of the survey, let's remember the time frame, because it was before we had the 90-day pause. That's when really sentiment was at its lowest. But look, when we think about the tariff package that was announced, that clearly is going to shave some growth from the U.S. If the U.S. sneezes, the rest of the world catches a cold. And so equities, you think about fundamentals, that's going to bring down earnings expectations both here and outside the U.S. So our clients are asking, what's going to happen with the U.S. economy? What's going to happen with the consumer? And we need more certainty from the administration on what they're agreeing in terms of tariffs with individual countries now that we have the 90-day pause.
But Sinead, in terms of what fund managers want to do, I thought Bank of America had a striking chart showing that I think about 50% want to be underweight. And as it stands, they're only net 36% underweight. So it looks like we have more room to fall further on the S&P.
Well, let's think about what markets are pricing right now. There's roughly a 50% chance of recession being priced in. So, yes, we've seen a bounce over the last couple of trading sessions, but that feels about right to us. So we're neutral on equities. We had been overweight. We reduced that a couple of weeks ago. And do you want to go underweight stocks from here? Well, let's just think about the very strong reaction we had in markets over the last couple of sessions when we got some more positive news. So I think that's telling you a couple of things. One, we're probably pretty fairly priced here given what we know. The situation is fluid, true, but given what we know now, it's fair. But the second is that there's a huge desire to buy in. So if you decide to go underweight, you better be prepared to move very quickly.
Well, that was going to be my question. I was looking at the sectors performing this year so far, and it's not a lot. Most sectors in the S&P 500 are still in the red, and if you believe we're going to get to 5,600, we're around 54 right now. Why not buy? Is there too much worry about more downside risk from here?
Look, I think fluid is the key word in terms of the situation because there's a lot that we just don't know. And that's why you had such a strong market reaction when the tariffs were announced, because they were a lot more than had been anticipated. The big outstanding question is the tax package. So the consumer has been driving a large part of the U.S. economy. We know it's been the top 10% of consumers that have really been spending. And so if you're going to hit the consumer with higher prices, the risk is that if you don't have an offsetting tax package, that really causes them to pull back. And frankly, we're more concerned about growth than inflation as a result of tariffs.
Right. And the administration has teased that, taxes, something on taxes might be coming in the second half, but certainly feels far away at this moment.
Also, that's just an extension, right, of what we already have. That's not a tax cut.
Something on taxes. Yeah. Sinead, you're sticking with us through the opening bell. A really interesting note that you made on positioning there. And you have to wonder if everyone is rushing to one side of the boat, maybe you want to get on the other side. Maybe it could be skewed as a bullish signal there, but we're going to discuss all of that and more with Sinead coming up at the opening bell. Your setup heading into the ringing, you can see the S&P 500 pretty much unchanged. It's been there for a couple hours now. The NASDAQ 100 trying to build on some of the momentum it's picked up over the last 2 days, falling a little bit flat, and then the Russell 2000 also seeing some red. The open is up next. This is Bloomberg.
We are moments away from the start of trading on this April 15th. It is, unfortunately, tax day. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at really little change on S&P futures right now. As Katie mentioned earlier, we've had a couple days of gains. We're looking at a NASDAQ that is gaining in terms of the futures picture. Small caps are down a little. Opening bells ringing at the New York Stock Exchange and the NASDAQ. The NASDAQ is here. No, this is still futures. That's the NASDAQ. Okay, Virtu celebrating 10 years of listing on the NASDAQ. And I looked back over those 10 years. If you invested and reinvested dividends, you've tripled your money there. But at Caterpillar, you've done even better, up 350% over 10 years. So they have both been pretty good bets. Katie, in terms of the stocks that we're watching this morning, what are you seeing moving?
Well, I've got my eyes on J&J because the company maintained its earnings outlook. That's despite the potential for tariffs hanging over the pharmaceutical industry. You can see shares turning around a little bit relative to the pre-market, Sonali, currently up almost 1% if you're feeling optimistic and want to round up.
Yeah, if you're feeling optimistic over here, Bank of America and Citi on the rise. They are the latest banks to report a spike in trading revenue amid global tariff volatility. I will say both also held their outlooks for the year. Bank of America now up more than 4%. Citigroup up almost 2% right after the open.
All right, in China, as we've been talking about, ordering a halt to Boeing jet deliveries, as well as purchases and parts from U.S. companies. But of course, with 145% tariffs,
right,
those planes would be too expensive to buy anyway, wouldn't they?
So it's a little bit symbolic, but still symbolism worth noting. All
right, we have still with us BNY Wealth CIO Sinead Colton Grant. And you know what? I was looking, Sinead, at ChatGPT and trying to get it to give me a list of all of the tariff announcements that Trump has made. along with dates that the tariffs went into effect, times when he rescinded tariffs, and then carve-outs, right? I just wanted a bullet point, like, timeline. And AI could not give it to me. It just wasn't working. It's just too much information and too confusing. If it's that hard for, OpenAI, how difficult is it for your average CEO?
Well, look, I mean, you really need to think through what the potential implications are. But what every CEO wants is certainty. Certainty so that you can make decisions around investment, certainty so that you can make hiring decisions. And absent that, you pull back on spending. And in fact, this is one of the things that really concerns us about the uncertainty and the fluidity around tariffs, which is that if you're in that seat and you need to make a decision about, do I spend today or do I make that decision later, you are going to defer that decision, and that includes hiring decisions.
And I do just want to break some news here. When it comes to trade policy, Canada to give a 6-month tariff relief on some U.S. goods. So just to read that again, Canada coming out with 6-month tariff relief when it comes to some U.S. goods. You take a look at the S&P 500, moving higher right now up about 0.3 to 0.4%. Some wiggling there when it comes to the U.S.-Canada relationship, maybe a little bit of thawing. So again, it sort of speaks to how fluid this situation, how quickly things are moving. It's hard for executives. It's also hard for investors. But I want to go back to the positioning conversation that we were having before the break, because at least according to the Bank of America survey, things are feeling pretty negative. You have investors planning to further offload U.S. equities. And I want to bring you the question that I asked Matt. Does that create sort of a bullish counter trade there? Maybe it's time to get long if everyone else is doing the same thing?
Well, let's look at what history tells us in relation to that. It's always darkest before the dawn. In other words, the sentiment gets really, really poor right before the market bottoms. And the market is looking 12 to 18 months out. It's not looking at exactly where, how things are today, right? So yes, look, if you're going to take a 12 to 18 month time horizon, you assume that growth in the US rebounds, then we're getting close to the point where you may want to add a little bit to equities. And look, I think being short equities here is a challenge unless you are incredibly dynamic and can trade quickly.
So what about other places outside of equities? At this point, do you think that given how much we've seen equities sell off, you are getting, frankly, since Liberation Day, more positive headlines coming through, like this Canada pause, as we've been talking about? You're seeing the S&P turn around, the Trump administration themselves walking back some of the toughest that you've seen. Treasury Secretary Scott Bessent basically saying that they set a high bar here, right? And now it's about negotiation. The assumption you're seeing from investors is negotiating back from that. So why is it so hard for people to call a bottom?
I think there are two things happening here. The first one is that the market has a little bit of PTSD because it was so shocked on Liberation Day, and you're seeing hesitancy around anyone getting a little bit ahead of what's actually announced. But the second piece, Sonali, that I think is really being missed here is if the U.S. growth is coming down, that means growth around the world is coming down. And what we should really focus on here is what are the agreements that other countries are making with the U.S.? How are they thinking about their exposure to China? Because frankly, if you're in the EU right now, you're looking at a wall of China exports potentially coming to your markets. And we've seen how poorly that played out for the auto industry in Europe. So you've got to think that behind the scenes, there's a realignment across trading policies generally outside the U.S.
Where is a good safe haven now? Because treasuries have been difficult, right? The dollar has been poor. Obviously, the Mag 7 is no longer the safe haven it once was. So what do you think?
So look, if you really want a safe haven, you want the Swiss franc, and that's actually behaved in the way that you would expect. I actually think the behavior of the dollar has been quite unusual, right? When you've seen treasury yields going up, usually that would mean higher rates, a stronger dollar. You've actually seen the dollar weaken. I think that's more of a temporary phase. I think the dollar will return because if we're looking at weaker economic growth around the globe, that should weaken the euro, that should weaken the pound, and it should weaken the yen, frankly. So, but as of today, I think the safe haven that's acted in the way that you would expect is really the Swiss franc. But if you want to look at equity markets, if you want to take a little bit more risk, utilities can look interesting. And that's not just about, the traditional utilities, but also thinking ahead about demand for electricity, for many of the new technologies that we see coming on stream.
Sinead, we thank you so much today for helping us navigate what has been a very complicated environment for investors. That is BNY Mellon CIO Sinead Colton Grant. Now, I want to bring you some breaking news as well from our Bloomberg team. Elliott is said to build over a $1.5 billion stake in HP Enterprise. They are working with the company. They plan to engage with the software and networking company to boost value. Of course, this is according to people familiar with the matter. The details have not been made public. It is one of the company's top 5 investors right now, according to data compiled by Bloomberg, and the exact intentions could not be immediately learned. You're seeing just the shares soar. Matt.
Yeah, it's interesting to see this, and I wonder if we see more purchases by people or funds with cash, right? I mean, obviously Warren Buffett.
KKR, we saw.
KKR, $8 billion in deals,
Stunning.
right? This week, and obviously Warren Buffett. We've been talking about how much cash he has. He's been selling into this downdraft, and so he has a lot of dry powder.
Yeah, absolutely. We'll see if Warren Buffett finally makes a move. It's something we've been waiting for several years. We do want to get back to that Canadian breaking news. This coming from a press release from the Department of Finance in Canada that Canada is going to give a 6-month tariff relief on some U.S. goods. A little bit more detail there. Some automakers will be eligible for exemption from Canadian tariffs. Canada announcing a remission framework for the auto industry. So we pulled up some of the automakers here, not really moving as a block right now. You have GM, you have Ford down on the day. Then you see Stellantis, maybe Tesla moving a little bit. Ford is pretty heavily reliant on the U.S., isn't it?
Well, Ford is, of the big 3, assembling the most of its vehicles in the U.S., right? Only 25%, I think, of Ford's vehicles are assembled in Canada or Mexico that are sold here. GM, it's closer to 35%, and Stellantis, it's over 40%. But you could argue that some of these moves were yesterday. As we start to see more carve-outs, as we start to see more tariffs rescinded, maybe investors have said, okay, he's not really going to go through with this. And General Motors today is soft. Yesterday was up 3.5%.
And a lot of this does have to do with automakers. They do give a real recognition of the integrated nature of the North American automotive sector, but they do also have other goods privy to that 6 months relief, including goods used in manufacturing, processing, food and beverage packaging, and things for public health, healthcare, public safety. So very interesting how targeted these nations.
And this is Canada maybe trying to do a little bit of negotiating before they sit down with Scott Bessent, right?
Yeah.
Saying, hey, we'll give you, this is an olive branch, maybe you could see it as.
Yeah, and it's interesting, again, to parse through this press release. When it comes specifically to the automakers and those remissions, the remissions granted to these companies is contingent on these automakers continuing to produce vehicles in Canada and on completing those planned investments. The number of tariff-free vehicles a company is permitted to import will be reduced if there are reductions in Canadian production or investments. So clearly setting the stage for those negotiations.
Great call out, because you have to wonder if Scott Bessent is going to say, okay, we'll let you take our manufacturing there.
Well, no, and you heard President Trump the other day saying he may give automakers a reprieve because many of these automakers are producing in Canada and Mexico, and they want to move that production to the U.S. I will also say it's not terribly easy to sell U.S. vehicles in Canada already. The prices are much higher. And you don't want to buy a used car from Canada because you don't know the history. That means residual values are lower. Yeah, who knows what they're doing with their cars up there.
We are going to now get a look at more stocks moving under the hood. We're going to bring in for that Isabel Lee, Bloomberg News.
Hey, Shonali, we're looking at Applied Digital. It's edging lower by more than 20%. So the company reported third quarter estimates that missed forecasts, especially for revenue and adjusted EBITDA. So Applied Digital is a company that builds and operates big, powerful data centers to support artificial intelligence and cloud services. So we have Needham saying that the results were softer than expected because of technical difficulty, which weighed on cloud services. And they also said that they need to improve on their outlook. Roth Capital Partners cutting the price target, as well as Cantor. Up next, we're looking at Rocket Lab. So this one is a different story because it's edging higher by as much as 10%. So the company secured defense contracts in the U.S. and in the UK. So in the U.S., the Air Force has selected Rocket Lab for a $46 billion contract. And in the UK, we have the Ministry of Defense selecting the firm for about $1.3 billion. So this just highlights the growing role that the company is playing in aerospace solutions. And lastly, we're looking at Netflix. So this one is also popping today. It's edging higher by as much as 3.5%. The company is aiming to double down on its revenue and reach a $1 trillion market capitalization by 2030. That's according to Wall Street Journal. Now it's around $400 billion, so a little more than double there, but they really have ambitious goals, and that's as we're seeing a lot of uncertainty in tariffs and macroeconomic policies, but still a lot of executives are ambitious for Netflix growth target.
All right, Isabel, thanks very much. Bloomberg's Isabel Lee there rounding up some of the stocks moving just after the opening bell. Coming up, we're going to talk more about Big Pharma prepping for new tariffs from the Trump administration. That story is next. Plus, we have a Big Pharma CFO, Joe Wolk from J&J, joining us a little bit later on Open Interest.
Well, we talked about chips, so let's take a look at pharma because the Trump administration has begun an investigation into pharmaceutical imports, which could lead to tariffs and broaden the U.S. trade war. For more on that story, we're joined now by Bloomberg's Madison Muller. And Madison, tell us what we know so far. It was interesting to see the CFO of Johnson & Johnson tell our print colleagues that he thinks that this will mostly be really focused on cheap generics versus, maybe some of the stuff that Johnson & Johnson sells. But what do we know about the scope of this probe?
So we don't know a ton so far. I mean, they are looking into API, which is the active ingredients used in pharmaceuticals, finished drug product. We don't know what the outcome of this probe is going to be so far. The J&J CFO seemed to think there could be a silver lining, that this probe will maybe show that generics are made overseas while branded drugs are mostly made in the US, and that could lead to maybe lower tariffs or no tariffs at all on branded drugs. So we'll see what happens, but they have a few months. They have 270 days to complete this report. They could finish it sooner. There could be an announcement on tariffs sooner, but it could still be a couple of months before we know what the impact will be on pharma and what the potential tariffs will be.
So what percentage of the drugs we take are made in the U.S.? Like if I'm going to buy Prozac or Xanax or Vicodin, Percocet, are those
Sounds
just
fun.
like a top 10 list here? Are those made here? Are the ingredients from here?
Yeah, so their pharmaceutical supply chains are super complicated, and if we take Lilly's best-selling drug Zepbound, for example, there are parts of it that are sort of made all over. So Lilly and all the other drug companies have manufacturing facilities all over the world. Lilly makes the starting ingredients, the active ingredients for Zepbound in Ireland. Then they ship it to the US for a second step of API. Then they do the fill finish here. So it's kind of, these supply chains are super complicated. They've been built up over several years, decades, and it happens all over the world.
I was denied once again for Zepbound.
Unbelievable.
Oh, wow.
I tried for Wegovy. Insurance said
sorry
no.
to
I
hear.
tried for Zepbound. Again, no.
Well, one thing that, just to kind of switch gears back to what you had mentioned before about the generics, because I think about this a lot in terms of what this means for lower income customers. Generics often help create a broader availability of a drug, do they not? So does that not create an availability issue if those are the ones that are facing issues?
Yeah, and I think that that's the concern, is that tariffs would hit generics a lot harder. Obviously, the margins are lower, and generic makers might decide, you know what, this isn't worth it, this is too expensive, we're just not going to make this product anymore. So I think that the concern, at least from the experts that I've spoken to, is that we could see drug shortages, we could see less availability of certain products. They could just decide not to make it anymore, it's not worth it for them. So branded drug makers might not be hit quite as hard, but for generic drugs, which are still mostly made in China or India, there might be more of an impact.
Yeah, a lot of moving pieces there. We appreciate you staying on top of it. That is Bloomberg's Madison Muller. And keep it here on Bloomberg Open Interest. We'll be speaking with Johnson & Johnson CFO Joe Wolk in the next hour, talking about many of the topics we just discussed and their unchanged guidance. But coming up more immediately, more tariff talk. We'll focus on a possible reprieve for autos next. This is Bloomberg Open Interest.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on with stocks. About 20 minutes into the session, we're up on the S&P, 0.7%. Third day in a row for gains. The NASDAQ up 0.9%. Small caps gaining as well. If you take a look at the big stocks, Nvidia and Apple, they're both adding points to the S&P. Not up a lot, 0.25%, 0.8%, but enough maybe to move the index. And then Boeing down on that news out of China, Tesla up, and GM down, even though you had what should be, Sonali, good news out of Canada.
We are going to dive deeper because, as we've been talking about, Canada says it will allow automakers to continue to import a certain number of U.S. assembled cars and trucks, and tariff-free, as long as they keep manufacturing vehicles in the country. Joining us now, Bloomberg Auto reporter Keith Naughton in Detroit. How much, ultimately, of a reprieve does this create? You certainly are getting a pretty mixed reaction from investors.
Yeah, it's a real clever exemption from Canada because they recognize they're in this battle now with the United States for car production. So they're saying, we'll let you bring your cars into Canada tariff-free, but you have to keep building cars in Canada. And there are a few, factories out there that are sort of hanging in the balance. Ford is overhauling a factory in Oakville, Ontario, that's supposed to build pickup trucks starting next year, but that sometimes is in question. GM just shut down production of its Bright Drop electric vans in Ingersoll, Ontario. So there are things going on in Canadian car production, and they want to make sure that they still get that. And that's what these exemptions are all about.
Yeah, it's a really interesting move by Canada. Let's get specific when it comes to the different automakers and how it might impact them, because we were talking about before the break, you think about Ford, which does a lot of its manufacturing in the U.S. How does a Ford fit and fall under what we're talking about here, this move from Canada?
Yeah, so as I said, Ford is supposed to start building Super Duty pickup trucks next year in Oakville, Ontario, where they once built the Edge SUV and where they thought about building electric vehicles. There's been a lot of uncertainty around that assembly plant. Ford has another very important factory in Windsor that makes engines for its best-selling F-Series pickup trucks. That's a critical factory. And, there's been great concern that those engines will face the 25% tariffs coming back on this side of the border. So Canada is important for Ford, but they're not currently producing cars there like General Motors and Stellantis is.
I wonder what kind of market it is. How important is Canada for U.S. automakers? They have a lot of car reviewers. My favorite YouTubers, the Straight Pipes, are out of Canada. I think Throttle House is out of Canada. Ryan Fortnine is out of Canada. But they're not really that many Canadians, right? And they have to pay more for their cars anyway.
It's a very small market, Matt. You're absolutely right. It's nothing like the 16 million new cars that are purchased in America each year. Pales in comparison. But it's an important production hub for automakers, including Toyota, by the way, which builds a ton of cars in Canada, and Honda. So it's important that the flow back and forth be no tariff or low tariff.
All right, Keith, really appreciate you hopping on to talk about this breaking news. Our thanks to Bloomberg's Keith Naughton joining us from Detroit. And don't miss our interview coming up with the CEO of Hyundai. That happens in about 30 minutes time. I do want to get back to these markets right now. The S&P 500 up. It hit session highs higher by about 0.7%, coming back a little bit right now. You can see that big tech is really leading gains today. If you look at what's moving in the S&P 500, moving us to the upside on a points basis, it's Nvidia, it's Microsoft, it's Netflix. Johnson & Johnson is a weight to the downside. We'll be talking to the CFO in just a little bit. The Russell 2000 also managing to do a switcheroo here. It had been lower pre-market, now higher to the tune of about 0.8%. I will note once again, you guys, that volume is pretty light on a 30-day average. Relative to that, we're down 26% right now when it comes to trading volume. So clearly, again, folks just a little bit tired and waiting for the next catalyst.
Yeah, but at the same time, you see a lot of support from governments like Canada, as we've been saying, and also, frankly, the Treasury Department, between Scott Bessent coming out and talking to Anne-Marie about the support that they're willing to give, his number two in Washington speaking about the support they're willing to give to the banks. And so there's a floor being created.
Yeah, and there's also the fact that a lot of times uncertainty means inactivity, right? Which may be why you see volume drying up. We'll talk to our next guest about that. David Kostin joins us from Goldman Sachs. Plus, we talk to J&J's CFO, Joe Wolk, and Wendy Schiller of Brown on Harvard. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, markets show signs of stabilizing. Stocks edging up as solid results from the big banks offset news pointing to an escalation of a trade war.
Global car makers get some relief as President Trump floats a potential pause in auto tariffs. The Canadians do the same. We'll speak with Hyundai CEO José Muñoz.
Plus, more from the C-suite. Johnson & Johnson holds its profit outlook steady despite looming tariffs. J&J CFO Joe Wolk joins us on Open Interest in about 10 minutes' time. But let's get a look at these markets right now. The S&P 500 higher by about 0.5%. This would be a third straight day of gains for the S&P 500. The Nasdaq 100 big tech really pushing this market higher. You can see some outperformance there. And then the bond market pretty quiet for once. Of course, we've seen 10-year yields come in quite mightily over the past couple days. We're still above 430, but 430 is not 4.5%. So the bond market looks like it's behaving right now, Matt Miller.
All right, let's talk about these markets with David Kostin, Goldman Sachs Chief U.S. Equity Strategist. David, thank you so much for joining us this morning. I want to start with the question that, in a sense, Katie posed at the end of the last segment. We're looking at volume that has dropped sharply from the last 20 or 30 days, but even over the last 100 days. And I'm wondering to what extent uncertainty and confusion leads to inactivity from investors.
Well, certainly there's a high degree of uncertainty. Largely that's around the policy of the exact nature of the tariff and the likelihood or not whether there'll be a recession. And our economists here ascribe around a 45% probability of recession in the next 12 months. So the base case is, in fact, not a recession. The economy continues to grow. And so, Matt, the way we think about it is from a market pricing perspective. The equity market is pricing as though the economy is going to grow around 1.5%. That's right now. We make that conclusion based on looking at the relative performance of cyclical stocks, long, short, defensive stocks. Cyclicals versus defensives, that's correlated or scored relative to the GDP growth environment. And that would suggest the economy, the equity market right now is pricing as though the economy is growing 1.5%. That's a little bit above where the Goldman Sachs economists think the baseline growth is. And it certainly is not pricing in the risk of recession. And so all of the conversations we have, of which we have many each day with CEOs and chief financial officers of different companies, are about how do they signal the guidance? Should they be withdrawing guidance for the quarter, for the year? Should they widen the range? How does one think about giving guidance to the investor community? So there's a lot of uncertainty for obvious reasons, and that's reflected, I think, in the performance of the market right now, which is stabilizing these levels.
Well, David, I want to talk about how technical factors such as liquidity factor in, because actually the Goldman Sachs Prime Desk said last week on Wednesday, top-of-book liquidity on the S&P 500 futures was near all-time lows heading into the crash-up that you saw on Wednesday. I know that you recently said in a note that liquidity has deteriorated pretty sharply over the last couple weeks. And when you think about the sort of negative feedback loop that creates with volatility, what actually breaks the cycle? What brings more liquidity into the market?
Well, the reason for there's several reasons for low liquidity, one of which is the uncertainty around what's taking place. And one of the consequences of a less liquid market is more volatility in either direction. Doesn't take necessarily dramatic changes in sentiment to have price action it's pretty dramatic. And you saw that, of course, last week in sort of spectacular fashion. What would provide a environment for getting more liquidity would be some clarity on the policy front, and that would give confidence. Right now, we've seen big de-risking, if you will, on the part of a large swath of the hedge fund community. The retail investors have been relatively more confident in putting money into the market. So when we think about the risks, looking at what are the shares that investors are selling? Well, they sell, in fact, all of the shares that are more liquid. And so that is one opportunity. We look at the performance of companies with high liquidity relative to low liquidity. I think the bigger issue that investors really are focusing on is what is the growth prospects for the coming year. We're looking around 3% earnings growth. So if there was more confidence that you could have a better trajectory of corporate profits, that would be one reason for money to come into the equity market. That's kind of how we think about it.
Let's break that down a little bit more, David, because if you have investors that are so concerned that growth can slow meaningfully, if not turn negative, and the stocks are not yet all reflecting even where your projections might be from your team over there, why? What is it that's going to stall growth, and what are the indicators that you're looking for that would turn this tide around?
Well, what are the indicators for stalled growth? Certainly with the labor market. That's the principal issue. If we see that some stabilization, continued growth, we're not really seeing in the macroeconomic data that things are deteriorating. There's more of a concern around some of the sentiment indicators, which would suggest some reasons for concern. I think there's a question about what's the state of the consumer. So we think about the labor market, state of the consumer. We'll obviously get more of an update in the next couple of weeks with the earnings. But of course, earnings are really a function of backward-looking results for the first quarter, which is why the conversations with managements right now we're having are all about the guidance and how do they want to message that information, their perspective on what's happening in the coming year. So give you an example, right? You have usually around 20% or so of companies provide guidance in the coming quarter, the next quarter. And about 40% of companies or so offer guidance for the full year. So is a management team likely to give guidance in the current quarter? They want to withdraw that because of the near-term uncertainty. They want to continue to maintain their guidance for the full year, for example, because they have a long-term strategic strategy, or they want to do the reverse and say, look, there's really uncertainty later in the year because the possibility of recession remains pretty significant, certainly well above average, and they feel more confident giving guidance in the next quarter. So you've got two arguments on both sides of that. That's a big discussion. Should they widen those ranges? Should, in fact, managements give two different sets of guidance, a scenario under which you have a recession and a scenario in which you have an economy continue to grow? Way you think about that is that earnings traditionally in a recessionary environment go down by around 10% or so. And that would obviously be, in addition to having a multiple contraction as well. But that's sort of, route one and route two, if you will. The different alternative path is that you have the economy continue to grow. And our baseline assumption is that you'll get earnings growth of around 3% this year and earnings per share growing around 6% next year. And as you know, what the market prices ultimately is the forward year earnings. And so this year's return to the stock market will be a function of next year's earnings growth. And we have expecting the economy to continue to grow into the next year. That's really where the discussions are. And where is it that portfolio managers should be positioning? We're looking for companies where there's relatively high degree of less variability, less amplitude in their earnings growth. And so a lot of consumer staples companies are fitting into that camp. Yes, they're a little bit expensive, but from an uncertainty point of view, that, in our suggestion, would be an area of focus on for outperformance in the coming 6 months.
Outperformance and potentially safety as well, regardless of the economic scenario. David, thanks so much for joining us. David Kostin there at Goldman Sachs talking to us at the end about consumer staples. Let's get a look at some of the stocks moving at this hour. Bank America is one of them, climbing after traders there posted a record quarter at Goldman Sachs, record quarter at you name big bank. And
equities.
Yes. Citi inched closer to a key profitability target in the first quarter as the firm's traders, the traders topped expectations there as well, notching $6 billion in revenue. I'm guessing that's equities traders as well. And then Elliott is said to have built a large position worth more than $1.5 billion in HP Enterprise. We broke that news at 9:30 this morning. You can see the shares in HP Enterprise are up 7 1/3%. Coming up, Johnson & Johnson posts a strong first quarter. We'll take a look. Well, is it a strong first quarter?
It was strong.
I mean, the shares are down 0.6%. So maybe they're worried exactly about what the president has to say, even though J&J sees a silver lining to those tariffs. We're going to talk to the CFO, Joe Wolk, next. This is Open Interest. Now to high interest, to look at what's making headlines around the world. Billionaire hedge fund manager Bill Ackman is donating $250,000 to a super PAC supporting former New York Governor Andrew Cuomo in New York City's mayoral race. That contribution brings the total fundraising of the PAC to nearly $5 million. Cuomo has also received contributions from Walmart heiress Alice Walton, media mogul Barry Diller, and fashion designer Michael Kors. I thought Ackman was supposed to be friends with Whitney Tilson. Elliott has built a position worth over $1.5 billion in Hewlett-Packard Enterprise. The investment makes Elliott one of the company's top 5 shareholders. While artificial intelligence has fueled heavy demand for hardware, HPE hasn't been able to seize on the moment as much as its peers. Last month, the company said profit would be lower than forecasts as it contends with tariffs and weak margins. And Johnson & Johnson is holding its earnings outlook steady despite President Trump's looming tariffs on the pharma industry. The administration announced earlier it would conduct an investigation into drug imports, and the move is widely seen as a first step towards imposing levies on the industry. Katie?
Let's keep this conversation going now with Johnson & Johnson's CFO, Joel Wolk. Joel, it's great to have you with us. As Matt mentioned, you held your earnings outlook steady in the face of a ton of questions about how pharma will fare under tariffs. And I know that there's a lot of unknowns out there. Your CEO said on the analyst call that J&J is still analyzing any potential effects of this probe. But I do want to game plan a little bit here. If we did see the Trump administration come out with something close to 25% tariffs on pharma, for example, what would that mean? Would that cause you to either cut or rescind your forecast altogether?
Yeah, good morning, Katie. It's a pleasure to be with you and the team here today. I do want to call out just the great work of the associates at Johnson & Johnson. It was a really strong first quarter that enabled us to maintain our guidance, but there's a lot to really unpack there as we're covering some headwinds, such as dilution from a great acquisition we just made a few weeks back. Of 25 cents. And then we did account for tariffs to the tune of about $400 million or 15 cents approximately, but still maintaining the 1060 midpoint. What we've assumed in that $400 million is the tariffs that are in place today and the timeline on which that corresponds to those programs. So that is largely med tech, and that would include any items not exempted under USMCA. That would cover some aluminum and steel tariffs that apply in some of our med tech business. And then it also includes the China tariffs as well as the retaliatory tariffs from China. And that is probably the biggest component. 70 to 75% of that $400 million relates to that one component alone. So think about that. Those are products that have an origin here in the U.S. that are being sold into China. We'll have to see with pharmaceutical tariffs. The news came out last night about Section 232 with respect to national security interests. I think when you look at what actually makes up the landscape of pharmaceuticals and maybe countries of interest under that provision, it would lead you to believe that it's mostly generics. And 90% of prescriptions in the U.S. are generic today. The other factor it could be is what they call precursor type of ingredients, so hydrochloric acid, magnesium, products that synthesize the active pharmaceutical ingredient to kind of keep the pill together and make the biologic work. So we'll have to see where it plays out. Nothing in our estimates right now assumes a pharmaceutical tariff, but we continue to monitor the situation and speak to the administration, who's engaged with us on a regular basis to get our thoughts and views on a number of items. If you really want to bring jobs back, I think it really comes to the tax policy. And if you think about the $55 billion that we were able to commit to just in recent weeks, we were proud to do that because it houses our products in the system of innovation, great education system. And at the end of that $55 billion investment, all the advanced therapeutics from Johnson & Johnson will actually be able to be produced and sold here in the U.S.
So, Joe, I hear what you're saying. Just to follow up, so on the $400 million tariff expense that you accounted for in 2025, it doesn't include the investigation we've been talking about. How could it? We don't know what's going to happen. I want to just follow up on your last point that you made, because it's something that I've been wondering. I mean, how do you incentivize bringing manufacturing back to the United States? It sounds like you're saying that tax incentives would cause you to do it more so than punitive tariffs.
Well, let's look what happened since really the passage of 2017 TCJA, right? The biopharmaceutical industry in 2016 had about 1,000, maybe 1,100 manufacturing sites across the country. Today, according to the Washington Tax and Public Policy Group, biopharma facilities total about 1,600. Right? So the tax impact of having a 21% corporate rate, which, again, isn't significantly advantaged, but it's no longer disadvantaged to the prior 35% rate that existed, provided the opportunity for us to house some of the cutting-edge technology in both pharmaceuticals as well as med tech here in the United States. And I think we have to really have a focused conversation about the next dollar invested. If we bring back some of these products, they'll be close to the end of patent life, and probably there'll be better standards of care that currently exist. If we're going to maintain our reputation and our stronghold as the leading country with respect to healthcare innovation, elevating the standard of care every couple of years, I think that's an important aspect that we've got to consider with respect to tax policy.
When you're thinking about the tariff impacts, and even on your earnings call, you had so many investors trying to parse through the fine-tooth details, some of which that don't quite exist yet. You had mentioned the impact to generics relative to other brand name drugs, but if you do see an impact on generics, isn't there a daisy chain, a ripple effect there in terms of affordability of drugs in the United States and where people end up spending their dollars, where insurers end up spending their dollars?
Yes, Sonali, I think that's something that needs to be considered. I'm pretty confident, certainly the industry, and I don't think the administration wants to have people go without drugs that are necessary, essential drugs, if you will. In terms of the price increase, I would have the same conversation that we've probably had a couple quarters in a row now when we talk about pharmaceutical pricing. 60% almost of list price goes to discounting and rebates. Yet those discounts and rebates aren't ending up in the hands of the patient or the consumer that they're intended for. So the middleman, which you've heard from the administration, some talk around that, having a transparent, following that dollar, where does it go? In our business, particularly for pharmaceuticals, we have no price leverage, right? Our average decline in prices over the last 5 years has been about 3 to 4% each and every year. So the discounts continue to go up.
I pay a lot less for drugs when I lived in Germany, a hell of a lot less, and when I lived in the UK as well. So we're doing something wrong in this country with regards to what you guys are charging customers.
The one thing I would say about those same countries, Matt,
I want to ask you about tariffs specifically. Joe, I want to ask you about tariffs. If we look at a 25% tariff, and we've seen that big round number on other big industries, would you pull your forecast at that point, or would you still be able to keep it?
Matt, in times like this, we kind of come back to knowing who we are, right? And so we're one of the world's largest healthcare companies. We think we almost have a responsibility on days like this to tell the street what we know and what we don't know. We did the same thing in COVID. It worked extremely well. I think investors appreciate that transparency. It's too speculative to say what we may or may not do on a hypothetical at this point, but we're going to try to be as transparent with the investment community so that they understand what our positions are and what we may be doing to mitigate any impacts from a potential tariff.
Well, let's talk about mitigating. Again, so many unknowns out there. I know that you're awaiting for the results of that investigation, which just began, but have you taken any defensive actions? Have you thought about stockpiling some of the drugs that you have made overseas, or what does that mitigation decision tree look like?
Yeah, we've looked at putting inventory here in the United States, but we were already pretty, I'd say, maximized and efficient with respect to how we conduct our supply chain. We're not going to make rash decisions on 3 weeks of rhetoric. Quite frankly, we think about not just the next 3 quarters, not even the next 3 years. We're trying to build capabilities and put facilities that will enhance our capabilities to elevate that standard of care for patients over the next 30 years. And that's kind of how we approach it at Johnson & Johnson.
Joe Wolk of Johnson & Johnson, we thank you so much for joining us. Of course, on the heels of an earnings report, guidance stayed the same, but of course, tariff uncertainty being addressed. We appreciate it. Now, I want to bring you some headlines as well, because we are learning that the EU expects most U.S. tariffs to stay as talks make little progress. On the heels of these headlines, of course, you've seen the S&P 500 lose a lot of the gains for the morning, still up on the day, but well off of session highs. They are saying the EU's trade chief, according to people familiar with the matter, left meetings with little clarity on the U.S. stance. And this is after officials from the president's administration, the U.S. administration, indicated that the bulk of U.S. tariffs imposed on the bloc will not be removed. So some progress in some areas, some pauses in places for certain sectors, like in Canada, but certainly not at the moment when it comes to the EU.
Clarity, it's a word we keep hearing, and we keep hearing about the desire for it. You take a look at how the currency market is reacting. I want to pull up the Euro-USD pair because you can see the euro weakening against the dollar in the minutes after that headline, taking a dive lower there. The S&P 500 also pairing its gains. This is Open Interest. All right, welcome back to Open Interest. Let's take a look at this market and break it down. Still a lot of positive breath, not quite to the extent that we saw yesterday, but you can see we have nearly 300 stocks in the green right now, of course, 200 in the red. I think it's really interesting to see what is driving this market's higher. We're sorting this on a points basis. You have Netflix really is your biggest contributor to the upside right now. They were out with a report. There was a report on Netflix that they plan to double revenue by 2030. Remember, this company reports in 2 days' time. I do want to take a look at the sectors as well, because this is also an earnings story. Of course, you have financials in the green, up about 0.9% right now. We heard from Bank of America and Citigroup. At the bottom, you have consumer discretionary. You also have healthcare. We know that Johnson & Johnson, even though they beat on earnings, they weren't quite able to sort of comfort investors that the outlook will be better going forward with all those tariffs overhanging the industry. Much more coming up next. This is Open Interest.
Auto tariffs are in focus today after President Trump floated the idea of a reprieve for the sector. The president said he wanted to afford them more time to set up manufacturing bases in the U.S. Across the border, Canada said it will also allow automakers to continue to import a certain number of U.S. assembled cars and trucks tariff-free as long as they keep manufacturing vehicles in that country. Joining us is someone who has to chart the course amid a dynamic, let's say dynamic trade landscape. Hyundai Motor CEO José Munoz joins us here on set. Great to have you here. I know you're here for the New York Auto Show, so really appreciate you dropping by. 731 Lex. Talk to me first about your cars. Very popular in the U.S. Your business has grown tremendously. You have Hyundai, you have Kia, you have Genesis, which Katie bought one of. And you produce a lot more cars than people would expect here in the United States.
Yeah, you're right. So thank you, Matt, for having me. It's always a pleasure being with you. So you're absolutely right. So we are now the third largest OEM globally. And then definitely it is not new, but for the last 6 years or so, we have come to the conclusion that the USA is the most important market for us globally and is meant to continue to do so. So today we have factories in Alabama and in Georgia, and just 3 weeks ago, we opened a brand new factory in Savannah, Georgia, to increase production by another 500,000 cars. So we produce about 40% of the cars that we sell in America, here in America, and then we are, with these 500,000 more cars, we're going to get to 1.2 million cars produced. It's a big undertaking.
I do have one minor correction. I actually leased my Genesis. I didn't buy it. And I kind of wish I had, because I'm worried about car prices rising. And you did promise that you wouldn't raise your prices through June 2nd. And I'm curious, I'm not just asking for myself either, what happens after June 2nd to that price pledge?
Well, first and foremost, you know, as mentioned, we are very committed to this market. We announced just 3 weeks ago in the White House with our executive chair, Mr. Chung, our big commitment to America with a $21 billion investment in this country in the next 5 years. So this means that we are going to increase capacity up to 1.2 million cars, but we are also going to increase everything that has to do with the supply chain to be able to produce those cars, including green steel. So we're building a $6 billion state-of-the-art green steel factory. We call it the electric arc furnace in Louisiana. And in addition to that, we are investing in new technologies like Boston Dynamics, bringing more chips to America with NVIDIA, also in autonomous driving with Motional, and even with eVTOLs, Supernal here. So this is really big. So thanks to those investments, we're able to produce cars like yours. I'm glad you like it. GV70 is the most popular Genesis, followed by the GV80, and it's produced here in America, in our plant in Alabama.
So as a company that has made bigger commitments, $21 billion through 2028, this is another 14,000 direct jobs that you've reported. What do you think more largely of the tariff posturing by the Trump administration? Do you think some of it is actually working to bring more factory jobs onshore in the United States, or do you think that there's a real risk here that a lot of component parts get so expensive that it thwarts a lot of buying in this country?
Well, in our case, we actually took the decision to invest in our new Savannah plant during the first Trump administration. So you don't build a plant overnight, and you don't build plants thinking on incentives. So we took this decision some time ago, and then this came to fruition just 3 weeks ago, as mentioned. And then we don't look at things in the short term. Obviously, we like free trade. We think in our global business, because the components come from all over the world, free trade is the best for our business. But our commitment is such that we have to navigate through this situation. And in fact, when all these tariffs and uncertainty came to life, we wanted to reassure our customers that we would guarantee their prices. So that's why we came up with this, the Hyundai Customer Assurance Program, to ensure we will not increase prices during this period. Then after that, we will evaluate the situation, but we will always focus on bringing the best product to the market with the highest safety rates. We're #1 in America in terms of top safety pick plus, and then with the best quality and good features. And you have to always be competitive regardless of tariffs.
Can I ask about the rest of your supply for the U.S. market? I think about 40% you make in the U.S., right? I'm pretty sure that you produce cars in Mexico for the rest of the world, and then we get a lot of South Korean imports from Hyundai, Kia, and Genesis. Is that am I doing the math correctly? And then how does that Korean supply look? Are you talking to the White House? Are you talking to South Korea about getting carve-outs?
Well, in our case, in the case of Hyundai Motor Company, we produce in the U.S. We don't produce in Mexico, really maybe very minor, but we took a conscious decision to invest here in the USA. The rest of the production comes mainly from South Korea. Well, we are part of the Alliance for Automotive Innovation. John Bosella, the president, is representing the industry and is conveying to the government the needs that we have in the industry, which are pretty much common across the board. And then we know that there are some discussions between the South Korean government and the White House. We are not actively part of that discussion, and then obviously I cannot reveal what they talk about. But definitely we all want to ensure that there is a plain level field for everybody, so that we can compete in good terms in the market, and we want to be competitive. I maintain this message for the consumer. We will be competitive, and then the market will decide, depending on the supply and demand, if there's going to be some price increase or not. But again, we need to be competitive.
Right. So that's what I was wondering. I mean, what does competitive mean? Does that mean you're eating the costs to keep your market share, keeping your costs that consumers pay, car buyers pay, and willing to take the hit? Or, how does that dynamic work?
That dynamic is not different to the way it's been done over the last 30 years or so. It's just simply, in the short term, an additional burden to manage, given all the implications of the supply. Again, our job is to focus on what we can control. The cost is something we can control. How are we responding to the increase in tariffs? Localizing, investing more in the country so that we don't get to be hit by tariffs. That's a simple solution. situation. And then on the revenue side, we'll have to see how the market reacts. If we have the opportunity to take maybe some reduced incentives, increase price here or there, we will do, but you're not going to see like a huge increase all of a sudden, or we are not planning to remove cars from the portfolio simply because of the tariffs, etc. Again, the most important is a good product, safe product, good quality, good features, and be competitive in the market. And then the rest is our job to try to optimize through localization.
José Muñoz, Hyundai CAO. Amazing coverage here because, of course, certainly very dynamic, let's call it, time in terms of tariffs. And also the time for the New York Auto Show. I grew up going there every year of my life. So looking forward to seeing you there. Katie.
All right, let's talk about these markets. The S&P 500 giving back some of its gains, but still green on the day. This would be the third straight day of gains for the S&P 500. But you take a look at these levels, they're not too exciting. We're still at 5,400 or so. I remember
5,420.
54.20. Yeah, I'm glad you got that in, Matt Miller. We're still, at pretty low levels, especially when you consider coming into this year. It seemed like the year-end target everyone was coalescing around was 6,500. So still quite a hole to dig ourselves out of here. But let's get specific. Let's talk single stocks. We'll do that with Bloomberg's Bailey Lipschultz. He's sitting to my left. What do you got?
Starting with Albertsons, the grocery store operator that was supposed to be in a merger with Kroger, but that got shot down by the federal government. But we're seeing shares under pressure today after reporting results that, at least in the first quarter, were mixed according to analysts. But the big thing, Sonali, is that their guidance for 2025 lower than analysts were expecting. That also does not include the impact of tariffs. The management team did talk about how their supply chain, broadly speaking, is domestic, but there still is so much uncertainty with everything going on from the Trump administration on what tariffs can look like. So when you look at a grocery store, obviously this is a company that's been down and to the right for the last few years, given some of the competition from the likes of a Walmart. But broadly speaking, another kind of negative update, again, when you look at what management was talking about for 2025.
And not the only stock that tariffs have moved in today's market. Boeing, obviously, getting caught up in the trade war. And now, China's ordering their airliners not to buy this plane.
To halt the deliveries, that coming from a Bloomberg News report. The stock down just over 2%, so not a huge kind of move lower, but definitely underperforming the broader market. Again, this tit-for-tat trade war going to actually impact the underlying businesses of some of these companies. And when you look at what analysts were looking for, China is a big driver for the decades out. So this is an impact, obviously, right now for Boeing and what it could look like in the near term. But broadly speaking, when you look at Boeing, you look at Airbus, China and Asia are big areas for kind of that growth trajectory going in through the back half of the decade and into the 2030s.
Bring us the latest on Netflix. It's having a good day.
Having a good day. Stock is rallying. This coming after a report overnight about the company expecting to double revenue by 2030, talking about plans of being $1 trillion company. I also want to run $1 trillion company as well, but that would be 3xing the stock, or at least the market cap from here over the next 5 or so years. But nonetheless, analysts really kind of applauding the different levers the company can pull. If it's focusing on revenue, does that mean leaning into more advertising kind of based products and platforms? And also maybe we're just going to continue to see the company, like others, with subscription basis, just ramping up those costs.
I do want to point out Netflix shares are higher by 10% year to date. You don't see many year to date charts that look like that.
Remember when the FANG was a thing? And Netflix was one of those, but now it's not part of the Mag 7?
We gotta reinstate them because they are certainly outperforming. Netflix also reporting in 2 days' time. That will certainly be fun. Our thanks, of course, to Bloomberg's Bailey Lipschultz. Now, coming up, Harvard is fighting back against the government's plans to force change at U.S. colleges. We'll speak with Wendy Schiller of Brown University next. This is Open Interest.
Now, Harvard is rejecting the Trump administration's effort to force change at U.S. colleges. President Alan Garber arguing that expanded requests crossed red lines regarding academic freedom. As a result, a government task force on anti-Semitism is planning on freezing $2.2 billion of multi-year grants to the school. Joining us now for more, Wendy Schiller, director of the Taubman Center for American Politics and Policy at Brown University. This happened very quickly. You had had first that reaction from Harvard just really a day or so ago. Then you had the reaction from the administration really within a matter of hours. And you do have Alan Garber saying that the intention is not to work with the college to address anti-Semitism, but rather some of the demands outlined by the government are aimed at combating regulation of intellectual conditions at Harvard. What does Harvard's stance here say for how other universities might react and the relationship between the government and elite U.S. colleges in the United States?
Sonali, I think this is a defining moment for institutions of higher education, particularly ones that have a fair amount of wealth in terms of their endowment, but also all of our education institutions, including a lot of state schools in red states and blue states and purple states that rely on government funding in all sorts of ways to fuel STEM, technology, engineering, healthcare, and also just to support students in their community economically. And, you know, this isn't just Harvard or Brown or Columbia. This is higher education and its dependence on federal funding. Harvard sort of, you know, threw down the gauntlet. The administration froze but did not cancel the $2 billion. And that's a very important distinction. It leaves some more wiggle room to negotiate, but Harvard's such a target and an easy target for the administration. It was surprising that they did that so quickly. You know, Brown's alternative has been to say, we'll stand up for things, but we will talk to the federal government. At least that's our policy, according to the president in the last couple of weeks of Brown. So, you know, there's a difference there. The numbers are much bigger for Harvard because the dependency is much bigger. And you have to ask yourselves, are you really, you know, do you lose Pell Grants? That's for lower income families, and that's really important as well. Student loan access for graduate education. There are a lot of levers the federal government can push. So, you know, this immediate reaction by Harvard seemed surprising to me.
On the one hand, Wendy, it makes sense to me that a private institution would fight for its rights to act independently, especially one as important as Harvard. On the other hand, you'd think that the U.S. government wants its best universities to continue to outperform the rest of the world, you know, to keep some kind of American exceptionalism. How do you think the Trump administration feels about this relative advantage that we have in our Ivy League schools?
Well, Matt, this is the big question we're trying to figure out when we think about the Trump administration and the Republican Party in Congress and the people who voted for Trump and Republicans in 24. It's, yes, driven by a lot of people with less than college education. Only 40% of America ever goes to any college. But it's also driven by independent voters that voted for Biden and then came back to Trump in 24. Where will they be in 26? And so how are the Republicans in Congress feeling about the decimation of their college towns, whether it's elite or private or public? You know, if you take away this engine of growth for the United States economy and also educating your constituents and their economic opportunity, what do you replace it with? And I think there isn't really a clear, coherent message coming out of the Republican Party. And that's my question mark going forward. When will members of Congress start to stand up and say, you will decimate Mobile or Birmingham, Alabama? You'll decimate Chapel Hill, North Carolina. You know, that's a big, you know, question mark. And that's where I'm seeing it. Because otherwise, their base isn't as concerned as with college aid as they are with tariffs and the impact that that could have on their jobs and spending power.
Well, let's stay on that, because I have been wondering, you know, when it comes to a lot of these policies that are coming out of the Trump administration, what is the ultimate tempering device? When do we start to see congressional Republicans start to push back? It seems like you've started to identify some of the issues where that support might waver.
Yeah, Katie, I think the next really big thing is Medicaid cuts, and I'm leaping to that because there are some hospital subsidies in Medicaid and Medicare. I'm thinking about someone like Josh Hawley from Missouri, a very conservative Republican, who has said, listen, you know, we really need it in Missouri. I'm not going to sign on to $880 billion of cuts without some knowledge of how it's going to hurt Missouri. And that's a big salvo also to the Trump administration, because in the end of the day, to get those tax cuts, you need at least 5 Republicans to either stick with the party or defect in the Senate. And if you're going to cut Medicaid drastically to get the tax cuts, I'm just not sure every Republican senator will sign on. I think the House is much tougher terrain to block Trump. They seem to be completely lockstep with Trump right now. But the Senate is a place, because only a third of them are up for re-election at any given time in 26, that a lot of those Republican senators have some leeway to push back. So I expect to see them pushing back on those kinds of issues much more readily than things like college aid. But tariffs, the president's all over the place. Nobody knows exactly what the tariffs are on or how long they'll last.
No.
But it's already affecting consumer confidence, and that's a problem for the party.
It's so confusing, and I wonder, Wendy, to what extent is this, fire hose of fog part of the Trump administration's political strategy? Do they want this chaos and confusion on purpose?
I think the default for all of us political observers is that there's a strategy. We've always been used to a president who's got a plan, a president, except for the first Trump administration, and they do have a plan. The plan is we don't make enough things here in the United States. We've lost hundreds of thousands of manufacturing jobs, and whole towns and counties and parts of America have been decimated as a result. That's true. You got to give Trump credit for pointing that out. How you bring those back for those people is a question that the Trump administration has not yet answered. And I think, again, going back to education, cutting education is probably not the way to attract the interest of industry in bringing back jobs to the United States.
Wendy, we thank you for your time this morning. That is Wendy Schiller of Brown University on everything from Harvard's reaction to the president and the tariff strategy. Stick with us. More markets ahead. This is Bloomberg Open Interest. Bloomberg's Anne-Marie Hornern sat down with Treasury Secretary Scott Bessent in Buenos Aires. He discussed how the administration's negotiation strategy has changed since the tariffs were initially revealed.
With the trade negotiations, I'm going to be part of that, and the president has hit a 90-day pause button, and we are moving quickly with many of our most important trading partners. So we had Vietnam in last week. We had Japanese in on Wednesday, South Korea next week. So it's going to move fast. And but the important thing for your viewers to know is we're setting up a process, and we are going to run that process. It's going to be orderly. And at the end of the day, especially for the most important trading partners, the president's going to be involved.
The Japanese prime minister recently said he's not going to rush to get a compromise and a negotiation. How quickly do you think you can see these deals come to fruition?
Well, again, I think there will be advantage to our allies, especially, and a first mover advantage. Usually the first person who makes the deal gets the best deal. So
who do you think will be first?
It's their choice.
Is there a handful of countries that you expect to have a deal before the 90 days is up?
Oh, I think there could be numerous countries. And look, it may not be the actual trade document, but we will have an agreement in principle and be able to move forward from there.
So are we talking about a dozen or 70 plus?
Look, I think it's going to depend, but we're going to move with all deliberate speed. And again, it's going to be a process. It's going to be USTR, who just has mountains of data that they've been collecting over the years, because in a funny way, the tariffs are the easiest part. So a country with high tariffs, you can just say, okay, this, get rid of it. It's the non-tariff trade barriers that are more insidious, more difficult to spot, and it's probably going to take a little longer to exercise those demons.
And that was Treasury Secretary Scott Bessent speaking with Bloomberg's Anne-Marie Hornern yesterday. Let's get a quick check on these markets right now. We're off session highs, but we're still higher on the day. The S&P 500 trying to hold on for a third straight day of gains, Matt, but certainly we're seeing a lot of movement when it comes to the global trade picture.
Yeah, absolutely. Coming up tomorrow, Lori Heinel of State Street joins us, as well as Evercore Chairman Emeritus Ralph Schlosstein and KBW CEO Tom Michaud.